All right, welcome everyone. Hopefully this won't pop up on me again. We are, this is the May 2023 monthly market update, Clear Vista Financial Perspectives. We like to visit with folks that are interested about getting an update on what we see is going on in the economy, the markets, and the like. Jesse, you've got the agenda for today, correct?
Yeah, let's go over that really quick. So first, we're going to go over the April 2023 market index. We're going to talk about the four main indexes that we always do. Then we're going to go into our commentary, what we think's going on. And then we'll have a quick housing discussion, a few updates from the Biden administration. And yeah, we'll finish our discussion at the end with some questions. We would love to hear from you. You can send a message to info@clearvistafinancial.com. This is our new and improved way of interacting with you live during the webinar. So we encourage you to take advantage of that.
And it's compliant too. For
it also is compliant.
Our compliance team that likes to make sure that we're staying on top of things. So send those questions to info@clearvistafinancial. That's the way that we can interact with you on today's program. So thanks for joining us. Jesse, go ahead and kick us off and let's talk about what happened in April with the markets.
Great. So we'll start off with the S&P 500 in April. It was pretty flat. You can tell most of our charts when we show these are pretty dynamic. They go up and down, or you can see a trend. You can notice that this one is all on the top and it's pretty flat. So plus 1.44% during the month, and it swung minus 2.8 from that high on 418 to 426.
Yeah, and the markets are rolled over, especially in the last 3 or 4 days. We don't have that on the chart, but prices are below that low point there a few days before the end of the month. Really, the market would have ended the month flat or negative if we hadn't had the last 2 days of really strong returns. That market since given that back up, but you know, we'll go forward with this. So, and Jesse, how did the NASDAQ do?
Real quick, Mark, I'm just going to turn the camera off so our viewers have a little more room to work with.
Yeah. There we go. They don't want to see us anyway.
Okay. So next is the NASDAQ, which is the tech heavy index that we cover. It's tends to be a little bit more volatile. That was truly flat, plus 0.05% during the month. It had a swing of minus 3.64. That's kind of the volatility we're working with there, between 418 and 426. You can see on the chart there, there's a high, it's a red candle in the middle, and then there's a low on the 26th. But we're still dealing with the resistance around 12,250. And it really is a continuation of what we discussed last month, where a handful of really, really large companies are moving this index.
Yeah, it was 6 actually, right? There's six companies that really moved the indexes up, the S&P 500 and the NASDAQ indexes, because of those 5 or 6 companies. And it's not the broad markets, which leads us to the Russell 2000, because the Russell 2000 was actually negative for the month of April.
Yes, it was.
It is showing us signs that the market is not participating with a lot of breadth.
Right.
And well, how that index do, Jesse?
Minus 1.79 during the month of April. You can also tell it's pretty flat chart as well. The swing between the 418 and 427 was minus 4.84, just for reference. And I just want to remind everyone the kind of volatility that we're dealing with this year so far. It peaked on February 2nd after a 14% rally up. And then it fell 16% to the low in March. So that's pretty high swings.
Yeah, and we're seeing that those lows being tested again. The Russell 2000 index has rolled over once again. We don't see it on this particular chart, but we're concerned that this, because there's a lack of breadth, you're not seeing the smaller companies participate in this rally. Really, the rally happened in January, we lost that in February. We have not regained those highs, and so we're seeing that rolling over again. I'll show you something in just a moment. Kind of gives you a perspective of what's happening in the market.
So last is our long-term Treasury index. These are very long-term Treasury bonds, and that was completely flat during the month, plus 0.07%. But you'll notice quite a big swing here, minus 4.96 between the high and the low on 4.6 and 4.19. It's kind of interesting what's going on. And obviously, this is going to be affected by the interest rate decision, which we'll talk about in a minute.
Yeah, and everybody's trying, investors are trying to predict which way the Fed is going to go. Are they going to cut rates, pause rates, raise rates more? We're going to get into in a minute, but there's still a lot of volatility in the bond market. We're seeing this continue to play out. It hasn't been the type of year that 2022 was, but 2022 was a 1 in 100-year type situation.
Very unique.
That we haven't seen since the Great Depression. But we're seeing more volatility this year, and it will continue to be that way.
Right. So we always like to show the 6-month trailing. This is more like an 8-month trailing mark. But tell us what's going on here.
Yeah, and this is basically showing, what I want to show is that if I can draw on here, I don't know if I can or not. I will try. This is the S&P 500, and what you're seeing is that we're in a rising price channel, and we have not been able to break out above or out of that price channel. Now, there's a couple of things here that are positive. All right, it's positive because you see prices are beginning to trend upward, and we want to see that. We're rising out of the bottom. October of last year was the bottom, at least for now, in the S&P 500.
Mm-hmm.
And we're seeing this price channel develop, but there's a lot of volatility and a lot of swings there. If you go back over here to looking at the peak here in February, we have not been able to regain that. And in fact, we're rolling over again. I know, Jesse, your data that you got on this chart doesn't reflect what's happening right now, but the S&P 500 has rolled over again.
Yes, it has.
And hopefully, this will be a test at this level here at the 4,061. I don't know at this point right now what the S&P is doing. I can pull it up on my screen real fast. It's actually at 4066 right now. This is on May the 4th. May the 4th be with you. And we're testing that right now. If it rolls below that level again, we maybe end up testing down here the lows of March again, which really were similar to the lows in January. Now, let me see if I can clear all this stuff off, Jesse.
Okay.
But this is still positive. We're just going to have a lot of chop in here when it comes to the S&P 500 and really the markets in general.
Yeah, and I drew that same line at 4,100, which has been a key line over the last few months. Last month, it was strong resistance, and you'll see that it went above it just briefly during the month of February, and then also some at the very, very tail end of March. And you can see that during April, we just kept going up and down, right around that line.
That's right. And I think that's going to continue for a while until the market decides which direction is going to go.
Right. So now we'll move on into some market commentary. And Mark, I am going to hand it over to you to talk about what happened with the Federal Reserve yesterday, actually, with their meeting in May.
Hey, lots of stuff going on. Okay. As we expected, the Federal Reserve raised their overnight Fed funds rate to a target range of 5 to 5.25%.
So that's a 0.25% raise.
That's correct. Now, their statement said whether or not they're going to pivot would come down to a meeting, looking at the data on a meeting by meeting basis. So this is really significant because they kind of changed the language. I'll get into that in just a minute. The decision was unanimous, and everyone voted in favor of that 0.25% increase in the rates. He said, Chairman Powell in his statement said inflation, the labor market, and credit conditions are all going to factor into future policy. He noted that the job market is still very tight. Now, this morning we had initial unemployment claims come in. They were up on a 4-week average basis, but the continuous claims were down.
Mm-hmm.
Two conflicting data points that causes more confusion for the Fed.
Right.
So these things are still really tight. We also saw wage data come out. It shows that we're still having wage inflation, even though unemployment's beginning to rise a little bit. We're still having wage inflation, which is not an indication that the economy is really cooling off. So the Fed also said at their meeting yesterday that that they would continue to reduce their balance sheet. There was no discussion about how they're going to do that. And then the other discussion was about, or not a discussion about, was how is the Fed even paying for its day-to-day operations? Because it's paying out more interest than it's earning on on its portfolio.
Right.
So that's a question. If I were in the room, I'd be able to ask that. So he asked, he answered several questions about the Silicon Valley Bank failing, and the debt ceiling and so forth. The market reacted. Both stocks and treasury yields were fairly muted. And then after the press conference, they declined about 0.6%. And two-year treasuries also were down about 6 basis points to 3.9%.
Right.
So quarter point percentage rate. What's the real commentary here?
Yeah. What does it mean?
Well, and you always have to try to read through the tea leaves, Jesse, when you're listening to the Fed, because
in terms of a statement, though, this one is actually gives a little bit of insight into the future.
It does, but then it doesn't,
Okay.
because you have to look at how now. I wish I could be a reporter in the room, because really what happened was there were about 2 or 3 questions that were asked 4 or 5 different ways over and over.
Right.
And the stuff that makes the news is the debt ceiling. The stuff that makes the news that worries people is, bank failures. Is that going to be the case, or is that going to continue? Chairman Powell said, hey, I think this is there's been a line drawn in the sand with these last 3 or 4. Of course, today, we're worried about Bank West and see if that stays afloat. They're looking for a buyer. But what was interesting was, if you read the statements, they removed some language from the previous statement that it says anticipates that in some additional policy firming may be appropriate. And a reference to future increases in the target range, they took that out. Now the emphasis in the statement is that further rate hikes may be appropriate, but they took out the reference to future increases. Okay. Now, in reaction to futures, we think the market is pricing in no more rate hikes, and with cuts starting in September. I think that's way premature.
Very premature, yes.
And in fact, we think that inflation will remain more elevated than the Fed projects, and that the Fed will likely raise rates at least one more time this cycle. Now, what that means is, and this was, I always forget his name, he's a Bloomberg reporter, but he actually knows what he's talking about.
Mike?
Was it Mike?
I think so.
I can't remember Mike's last name. But, asking about, the data for future rate cuts. And Chairman Powell said, hey, no, that's really not, that would be inappropriate right now. We don't think that's going to happen for a while, because we think inflation is going to stay sticky. And it's going to be really hard for the Fed to get their target inflation rate of 2% down from 4.2%.
Right. That's
going to hang around for a while. So, you can read the headlines about all the stories about banking turmoil and the debt limit and so forth. That's really can be a problem that can exacerbate the problem right now. But it's not the story. The story is one that we need to watch here, is about what is happening in the economy. And that really applies to the money supply.
Right.
And that's M2. For you economist geeks out there that are listening around, M2 is a measure of money supply. Now, M2 tells us what the net effects of all the Fed policies and the banking situation are. Now, during the first 2 years of COVID, M2 soared more than 40% in those 2 years, but it plateaued, and that was all because we were putting stimulus checks in the system and all sorts of different
check and
PPP loans and all sorts of different employee retention credits, all that money pouring back into the system. So it plateaued last year, and then it started to decline. Now, in the past 8 months, Money supply is down 4.1%. Jesse, that is the steepest drop for any 8-month period since the Great Depression. Now, if this continues through year end, it very well could likely create a deeper recession. And that deeper recession is what's going to wipe out inflation. Okay. It's not necessarily the Fed's micromanagement of interest rates and what can and they cannot do. But, you know, and I was so disappointed. I even tweeted out during the Chairman Powell's press conference last year, will somebody ask about M2 or the money supply? And how is the Fed funding its operation when it's running at a prolonged loss? That's unprecedented, right? For the modern Fed to run their balance sheet that way. It's groupthink. Instead, we think the same 3 to 5 cookie cutter questions, as I mentioned, are asked several different ways.
Right.
So basically, the Fed's still mixed up. And the reason it's mixed up is because the 2008-2009 crisis, back during that time, it abandoned its long tradition of implementing monetary policy through scarce reserves and imposed a new policy based on abundant reserves. And so they didn't know where it was heading at the time, but now we're finding out. And the turmoil, I think, in the markets isn't quite over. Now, I'm not saying we're going to have new lows or anything like that. I think it's going to be a bumpy ride. We still remain cautious on equities, and we do think that a recession is on the way. So why do we think that? Well, here's some data here to look at. This is the Treasury yield curve. And I've put this up before in previous month updates and so forth, but a normal yield curve looks like this.
That's what a healthy curve looks
That's
like.
what a healthy curve looks like. A healthy economy, healthy yield curve. This is where short-term bonds are down here on the left-hand side of the page. Longer-term bonds are on the right-hand side of the page. And we typically want to see lower interest rates on the T-bills, 1, 2, and 3 month T-bills, higher yield on the 30-year notes or bills. We've got the opposite. And this is still inverted, and which has started this way in March of last year. And we've been more than 12 months now where we've had some inverted yield curve.
Right.
And we talked about last month how an inverted yield curve tends to be a precursor to recession.
It actually in history, every single one has led to it.
That's right. That's right. So this month, and I think the yields have ticked up a little bit. You'll see this 4-month yield around 5.2%. That's a 4-month yield. So that's why you're seeing at your bank or credit union, you're seeing really high, comparatively speaking, really high short-term CD rates. And that's why it is. And then you see the 30-year rate around 3.7%.
And of course, these have changed now after the Fed decision, but this is as of 4/28.
That's right. So, you know, that's a lot here. And the thing that concerns me is that there are lots of contradictory opinions within the Federal Reserve staff, within the Federal Reserve regional presidents and so forth. And then Chairman Powell, who is the spokesperson for the Federal Reserve, says this time is different.
Yeah.
He doesn't think we're going to have a recession. And that's fine. He's entitled to his opinion, but his own staff keeps telling him, hey, we're going to be on a recession. So who do you believe? I don't know. We just have to let the data tell the story to us as we go along. Now, this is showing the New York Fed. Now, New York Fed is run by, hey, they sat on a bank, one of the banks that failed. They must be really good.
Still a big player in decision making, though.
This chart shows the New York Fed's probability of recession in the U.S. within the next 12 months. This is a very condensed chart, but you see that the probability has risen to over 57%, matching sentiment that we saw not since the early 80s and late 70s. Okay, so I don't have a crystal ball. Jesse doesn't have one either, and we don't know exactly if we will have a recession, but we want to keep an eye out for it.
So they say sell in May and go away, right?
That's the old adage.
That's not necessarily true, but we wanted to show this chart that just shows 6-month periods and the average change and what percentage of them actually went higher. And it does tend to be lower during this period. That doesn't mean that that's going to happen this year. We don't know.
I wish I could do that. Just
Yeah.
sell in May and go away. I could take the whole summer off and go have a long vacation. But you can kind of see here at the bottom here, the May through October 6-month time frame typically is one of the lower performing periods historically. That does not mean that it will happen that way this year, but historically it is a period of lower returns.
We got a report from our seasonality provider, and the amount of Google searches for that phrase is skyrocketing right now.
Really?
Yeah.
Well, it's May.
It's May.
I don't know if people are looking for a strategy that they can take the summer off and not have to look at their investments. Maybe that's it. So here, Jesse, we see how tech companies are relying on the Fed's pivot to maintain high valuations. Now look at the 20 to 2021 range on the bottom orange line. I'll draw down here.
Yeah.
With that, look at this range here, where the Fed's funds rates were basically zero during that time. Okay. Now, tech company valuations are above, and the black are high. So we had that zero range there. We're not seeing the same correlation with rising interest rates now and tech valuations, and tech companies depend upon cheap money to keep fueling their growth.
Mm-hmm.
These companies have had such a strong pull on the indexes, such as the S&P 500, and this kind of shows how impactful the Fed decision can be on your portfolio. We're still watching the mega cap tech companies mentioned in last month's webinar that we put up on the screen last month. But it's something that we have to keep an eye on, because rates and if the Fed leaves rates higher for a longer period of time, can really drag on the performance of the large cap companies.
Right.
So that's something we're watching as well. Now, here's kind of a comparison of growth versus value. We get questions.
Is a broad market comparison too.
We get questions about this all the time. Growth would be, Jesse, would you say newer companies that invest all the resources in expanding the business? They tend to hold less cash. They take more risk.
Right.
Value companies have been generally around longer, have proven track record, that are stable businesses with household names are likely to stick around for a while.
Yeah.
So what we want to focus on here is the black line, this black jagged line here. And when we see what we saw in 2022 was that growth suffered. A declining black line means that growth was underperforming value. Now, that doesn't mean that value is actually making money, because there are very few things last year that actually made any money. But what we can see here is that the first quarter of 2023, we had that improves, indicating that the growth value conversation is shifting. That's all it means. It's shifting. And so let's jump in, Jesse, and talk a little bit about housing.
Yes, we do have an update here. So the Biden administration worked with the Federal Housing Finance Agency to this new effect on May 1st. You want to talk about what happens to borrowers?
Yeah, and I had a long conversation with our friend and mortgage broker here in our building yesterday, and he said it was the craziest thing ever.
Really?
Yeah, and so what's happening here is effective May 1st, as part of the Federal Housing Finance Agency's push to get affordable housing, will effectively subsidize home buyers
and
refinancers with riskier credit ratings by charging higher fees to those with good credit ratings. So
people who have good credit and have saved up a lot of money,
they're going to be penalized.
Okay.
They're going to be penalized. It's going to cause a lot of confusion. We just wanted our listeners to know about this, especially if you're thinking about buying a home or refinancing your home. It's going to result for those people with good credit, and I stress this, with good credit and good credit scores, it's likely going to raise their monthly mortgage payments.
Mm-hmm.
Now, Bankrate did an analysis, and with someone with a below average credit, so we tell people, if you've got a credit score below 650, don't even apply for a loan. You're not going to get it in the traditional sense. You might be able to get some of the government stuff. But so let's say they were looking for a Someone with a below 650 credit score, let's say 640, they were seeking a mortgage of $350,000. They're going to put 20% down, which makes no sense to me because most people that have bad credit don't have 20% to put down. But this is the program. They typically beforehand paid about $10,000, $10,500 in fees before these new regulations started. They now will pay only about $7,800 in fees, but someone with a credit score of 740 exploring the same deal paid $1,750 in fees before the new rules, but now it's expected they'll pay almost double those fees.
Okay.
So
over $3,000.
Over $3,000. And that really is going to cause a lot of confusion. It may make homes less affordable for people that have good credit. And being able to make homes more affordable for people that have bad credit. Now, the indication and use of a credit score when it comes to home lending is really, they use it as one of the measures to see if not you're likely to repay this mortgage. So the risk hasn't gone away.
Right.
And there's no details yet as to what's really going to be done to offset that risk. But I was talking to our mortgage broker friend, and he's basically saying this is going to result in a lot of foreclosures. We might have a wave of foreclosures unforeseen before in the past.
Meaning people with good credit are having higher fees and they can't afford the fees?
Well, no, that or the people that don't already have the propensity to pay back things on a timely manner may default. So it's really complicated. There's more things coming out later on possibly about this.
So
let's talk about home sales.
Yeah, while we're talking about the housing market, I thought we'd talk about new single family home sales. So they increased 9.6% in March. This data comes out 2 months in the past. It's actually down 3.4% from a year ago. And the month supply of new homes, it fell to 7.6.
So we're seeing that those home sales are beginning to slow down, and existing home sales declined about 2.4% in March.
Right.
That is kind of lagged to consensus, right? So sales are down of existing homes are down 22% versus a year ago.
Yeah.
Where did the sales fall?
So the main sales fell in the Midwest, the West, and the South. And keep in mind that the data is 2.4% and 22%, not what the slide says. Sorry about that. But the median house price rose to $375,000.
All right.
So once again, people are still asking about banks. So I wanted to include this slide here. We have individuals still concerned about the banking system, and for good reason. The situation is evolving each week, but we still have confidence. Jerome Powell yesterday in his comments, the very first thing he talked about was stability in the banking system.
Yeah, and then PacWest pre-market today was down 42%.
Right, that's what I mean by it's evolving every day.
I don't know that, some of the same problems that Silicon Valley Bank had, I would suspect that a number of banks have still, and I don't know if that's over, but that's going to be the headline. Right now, the government has your back, right? They've already said that they're going to waive the FDIC limits if and protecting depositors.
Which is not sustainable, but for now,
right? And they're going to have to revise that somehow. So, the Fed chairman said, "Hey, we don't see that as a big risk. We think that the contagion risk is gone. That this is really much over." We just advise that you always want to look at your lender and talk to your lender to see if you're overly concentrating money in one account. You may want to spread that around. Now, different registrations, different accounts, you can each get $250,000. We have some cash programs through one of our advisor platforms that we have that you can get greater FDIC insurance and actually get you good yield as well. But you want to talk to your banker about what's going on with their bank, what's their financial health, because it isn't a system-wide issue. And we had a slide last month, Jesse, about talking about where the money went from First Republic and Silicon Valley Bank. this is not like the bank run in the 1929, 1930, okay? In that time period, money left the financial system.
Yeah, it went to paper cash and other things.
That's right. I mean, that's where that's where the saying of stuff your money in a mattress, because that's where people kept it. This collapse of Silicon Valley Bank, money just simply moved to other banks that people felt were less risky or more secure.
Mostly our giant bank friend, JP Chase.
JP Chase probably got about half of all the cash that moved out of the failed banks in the last month or so. So it is something that, you know, we'll continue to watch. It certainly had a big impact on bank stocks and still continues to have a little bit of an impact on bank stocks. But, you know, the money hasn't left the system. This is not a true run on the banks.
Right.
So what does this all mean to your financial plan? Well, we're always here to help navigate you when it comes to financial planning and the risk, no matter the stage of life you're in. We like to say around the office, there's nothing new under the sun.
Yeah. But
we also don't want to be saying gloom and doom for the economy. We just want to make it clear that our comments for our listeners on the current state of affairs.
Right. I think people might hear recession incoming, bank failure. We just don't want to be gloom and doom. It's not what we mean.
Those are the headline things.
Right.
Those are the things that are going to keep you glued to the television.
Right.
But these are just perspectives. That's why our program every month is called Clear Vista Perspectives, because this is just our view of the world, talking to a lot of other researchers and economists and so forth about what situation what they're seeing. But, you know, what does it mean for you? Well, we encourage you to check your statements, talk to a financial professional, educate yourself. Find a professional that you trust to help guide you through this process. And, you know, we think that it's always important that you talk to a professional. A lot of folks come in and they're worried and they've never talked to a financial professional before. But financial planning, that means being prepared for the unexpected.
Right.
Right. I was talking to a Marine a few weeks ago, and he was talking about how planning is different. Your preparedness is what you're trying to do. You're trying to prepare for any given situation. He talked about being on the battlefield, that you map out and you have a plan for what you're going to go in to do that mission. But a preparedness plan says, here's how we're going to respond should conditions change. What if that building is not there that they were expecting to be there? What happens next? And so just like a good Marine is prepared, financial planning is getting you prepared for the unexpected things that could happen.
Yeah.
And always just give our office a call if you have any questions about any current events or your specific financial plan. I want to remind people, and you can send questions to info@clearvistafinancial.com. That's info@clearvistafinancial.com. I am not seeing any questions on the board today, but you can always send us a message and at that email, and we'd be happy to answer that question for you. Folks, you know, it's easy to schedule an appointment with us to talk. You can visit my calendar just to schedule a phone call. If you want to meet in person, it's always good to call our office at the number on the screen there. And also always send us an email at info@clearvistafinancial.com. We'll be happy to talk to you about your situation or your question or concern. So Jesse, thanks for this data that you prepared for us. It's great stuff. Folks, we'll be talking to you again soon. And remember, the first Thursday, same time, same place of every month, join us again for Clear Vista Financial Perspectives. Thanks. You all have a great day.